Hi, this is Maddie Harper bringing you the February 2021 Multifamily Market Insight Report. Nationally, rents declined by 0.1% in February on a year-over-year basis. Although national rents were negative this month, we are getting closer to positive territory as rents have steadily shifted closer to positive since October. The national year-over-year declines is mainly driven by large gateway markets that have seen substantial declines in rent since the beginning of the pandemic. Because just looking out of our 133 markets that were surveyed this month, 111 had positive month-over-month rent growth. On the employment side, jobless claims fell 42,000 to 712,000 in the week ending March 6th. Claims are down about 200,000 from an early January peak and are close to a pandemic low point that occurred in November 2020. Occupancy, like we've been saying, has remained relatively steady over the last year, only declining by 0.3% since January 2020. The top two markets for rent growth this month remained unchanged, Inland Empire and Sacramento. Inland Empire had 7.6% year-over-year rent growth as of February 2021, and Sacramento had 6.4% year-over-year rent growth as of February 2021. Phoenix jumped up to the third spot this month with 6% year-over-year rent growth, and Las Vegas and Atlanta are new entrants to the top 5 markets this month. Typically, we talk about gateway markets being the 6 largest metros in the country. So those metros being Miami, Los Angeles, San Francisco, Chicago, Boston, and New York City. Seattle is close to that gateway market status and has been impacted almost as drastically as the gateway markets have during this pandemic. Rents are down about 7.7% as of February 2021. Seattle has a large concentration of workers employed in the technology industry, which is one of the largest industries that has shifted to working from home since the pandemic began. Zillow, which is headquartered in Seattle, recently announced that 90% of its employees would be given the option to work from home forever. The stance that other companies take on the work from home trend will have a major impact on how the Seattle metro, especially the urban core, recovers. Occupancy has declined in Seattle as well, down 1.4 percentage points since January 2020. I would suspect that most of this occupancy loss is concentrated in the downtown urban core, which has been hit hard due to companies shifting to that remote work. While the work from home trend has a negative impact on most expensive urban cores, many tertiary markets are benefiting from the shift. One example of that is Boise. In Boise, rents are up 10.8% on a year-over-year basis as of February 2021. Boise has become extremely attractive to people leaving California and looking for a place to go with lower costs while also being able to maintain that outdoor lifestyle. Occupancy in Boise has increased as well. It is up 1.2 percentage points since January 2020. Another metro that is probably mentioned a little less than Boise is Huntsville. Huntsville has also benefited from the work from home trend while also being a lower cost city. In Huntsville, we've seen year-over-year rents increase by 8.4%. United Van Lines recently released its annual national migration study, and Huntsville was the number 4 destination for United Van Line clients. Occupancy has also held up well in Huntsville. Although it did peak in July at 97.1%, January occupancy is currently at 96.6%, which is extremely strong for this market. For further market information and our outlook on the year, please join us on April 15th for an interactive conversation with Jeff Adler and Jack Kern. Thank you for taking the time to listen today. What market would you like us to do a deep dive on next month? Leave a comment below. Thank you.